What is the expatriation tax when renouncing citizenship? Imagine making a big decision to leave your country behind and start fresh elsewhere. But before you do, there's an important financial step to understand. When you give up your citizenship, especially in the United States, you might face something called the expatriation tax. This tax is also known as the exit tax. It is a fee the U.S. government applies to certain people who decide to renounce their citizenship or give up long-term permanent resident status, which is also called a green card. The main goal of this tax is to collect taxes on assets you own around the world, as if you sold everything just before leaving. So, who needs to worry about this tax? Not everyone. Only those classified as covered expatriates. To be a covered expatriate, you must meet at least one of 3 rules on the day you renounce. First, if your net worth is $2 million or more, you could be subject to the tax. Second, if your average annual income tax liability over the last 5 years before renouncing exceeds $206,000, you might owe. Third, if you haven't filed the required tax forms, like Form 8854, to show you are in compliance with U.S. tax laws, you could be considered a covered expatriate. Now, how does the tax work? The IRS treats all your worldwide assets as if you sold them at their current market value the day before you renounce. This is called a deemed sale. You then pay capital gains tax on any gains above a certain amount. For the year 2025, that exemption amount is $890,000. Gains below this threshold are not taxed, but anything above it is. This means if you own assets that have appreciated significantly, you could owe a substantial amount in taxes. Before you officially renounce, you need to file a final U.S. income tax return and submit Form 8854. This form confirms you are in compliance and helps determine if you owe the exit tax. If you do not file correctly or on time, you might automatically be classified as a covered expatriate, which could trigger the tax even if you do not meet the income or net worth thresholds. The process of renouncing citizenship involves going to a U.S. embassy or consulate abroad and taking an oath of renunciation. The date you take this oath is the official date for tax purposes. For Black immigrants who decide to renounce U.S. citizenship, this tax can be a big factor. It can be both a financial burden and a complex emotional decision tied to identity and heritage. Some may feel it as a step toward reconnecting with ancestral roots or leaving behind systemic challenges. Planning ahead is key. Not everyone who renounces will owe the tax. Many do not meet the criteria for a covered expatriate. If you are a green card holder and have been a permanent resident for at least 8 of the last 15 years, similar rules may apply when you give up your green card. Consulting with a tax professional can help you understand your potential liabilities and find ways to reduce or avoid the tax. In the end, the expatriation tax is a way for the United States to tax certain individuals who leave the country and own assets worldwide. For Black immigrants and others, this tax is an important part of the legal and personal process of renouncing citizenship. It reflects the complex mix of legal obligations, financial considerations, and cultural identity involved in this significant life decision.